I want to start this video with a short story. One day, several years ago, 2 or 3 years ago, I'm in my office and I get a phone call from an individual that had some questions just about cash value life insurance, how it works. Sure, people call in all the time, and he's asking me questions about policy design. He's saying, oh, like, how do you do that when you actually build the policy out? So I mean, with like the premium, PUA, the term riders and such, can you give me some specific details there? And I'm talking to him. He sounds a little older. I'm thinking he's a life insurance agent. So I'm like, okay, like, are you an agent? I just ask him on the phone. He goes, oh, no, I've got a day job, but no, I just like this stuff. He wasn't a life insurance agent. Okay, so all right, have the conversation with him. Turns out he was interested in cash value life insurance. He had been working with other individuals, just trying to get more information on the product, on the concept, how it works, because he wanted to see if it would work for him. Now, what came up top here, am I too old for cash value life insurance, really was his age. So he was 74, turning 75 at the time. Now, he had done very well for himself between his business, finances, everything going on. He had money in the market, but he was not comfortable allocating any more money in the stock market. In fact, when it got higher and higher, he elected to sell some off. He said, you know what, it's really high right now. I'm not comfortable continuously doing this, especially at my age. Maybe in the future, if it crashes, I'll buy some, but now I'm not putting any more money there. Has a lot of funds in bank accounts, CDs, money market, checking and savings, safe areas to position money. Now, this individual, as we continued to talk, had a net worth of over $10 million between his business, cash on hand, other assets, and he's in a position where he values having those funds for himself as he wants to invest in other ventures, do things personally, but he also has a wife, has 4 kids, has, I believe it's 10 or 12 grandkids. He wants to take care of them as well from a legacy standpoint, and today wants to gift them some money. So what he has going on, business and real estate presently that are income producing. He is a phenomenal businessman. His company is still producing. He's got 2 businesses. One is in the medical profession. The other is coaching other medical professionals on how to increase their revenue, the revenue at their practice. And then once they've done that, what to do with their money. Wiping out debt is his first objective, and then where do you put it that's safe and you can continuously use it? Just coaching, advice. He's very, very good at that. So he's considering a personal policy, $1.5 million. That's the amount of money we're going to look at shifting into a cash value life insurance policy, not the death benefit. Originally, his goal was, hey, on the cash value side, I am concerned about the death benefit, but I want to understand this cash value better and how to maximize it. Because he had seen some examples in the past that looked okay, but they just weren't. He called us for a reason. He wanted more information. So he's looking to move 1.5 million in, and then after that, if it works, Steve, then I'll look at policies for my kids, which I will fund, my grandkids, which I will fund, and then also other clients, coaches, the people I coach in finance. I won't fund their policies. However, if it works for me, I am definitely going to share this because I love the idea of what I'm reading about cash value life insurance. Core benefits are what? If it's set up properly, safe, liquid, tax-free area to position money. A lot of big banks and corporations shovel boatloads of cash there. Something's there, but what he had seen so far doesn't match up. So here's the most important thing. We're going to look at some numbers, but if I am in my 60s or 70s and considering a cash value life insurance policy. The question, am I too old? The answer is no if it is designed properly. We talk about this frequently. In this case, it is critical, more important than ever to make sure a policy is designed properly. And if we have health issues, it can be a problem to obtain a policy. So if we don't have any health issues or no major health issues, it can work, and you're going to see it here. So with policy design, when we pay any amount of money into a policy, where can it go? If you've ever seen a whole life insurance policy, we pay what? A premium. The thing is, when we pay any amount of money into a policy, the funding we're going to look at this example is 1.5 million over 6 years, which would be what? $250K per year. So if I'm paying $250,000 per year into a life insurance policy, and my goal as a 75-year-old individual is to optimize the cash value, what do I have to do? Well, premium piece. I need to minimize that as much as possible. We have it under $25,000. It's right around, in the example we're going to pull up here, $23,000. We have a term rider attached, but the rest is going towards the PUA component. Now, how these two work, premium dollars in year one do not show up in cash value. Beginning year two, they do show up in cash value. Why they don't show up in cash value in the first year, so when you look at a whole life insurance product, that is really where they're charging for the death benefit up front. Now, as we progress on, PUA dollars, we fund money into a policy via the PUA component, it shows up in cash value. It does purchase me some death benefit, but really, why individuals allocate funds toward this PUA component, this is the key to optimizing the cash value of a policy. Now, if you'd like more detail on this section, I would encourage you to check out one of our policy design videos on our channel. So that's step one. Step two is the mech limit. This mech limit really determines if a life insurance policy will still be considered life insurance and I can still access my money and use it tax-free, or if it will become classified as what is called a modified endowment contract, and I therefore have to deal with taxes. What has a direct relationship to the mech limit on any life insurance policy is an individual's age and total amount of life insurance. So we have this policy at just about a $250,000 mech limit, which is based off of his desired funding, $250,000 for 6 years. The death benefit is going to be about $2.2 million. So where we came up with that $2.2 million, that is the minimum death benefit we could possibly drive it to in order to be able to pay in $250,000 per year. If I carved this death benefit down to $1.1 million, what would happen is my mech limit would then come down to $125,000. So the death benefit and the mech limit have a direct relationship to each other. Age is important as well. If I'm a different age or gender, these values are going to be different. This is based on a 75-year-old male here. Let's take a look at the numbers and see exactly how it works for a 75-year-old individual. This is not the same case that resonates with the story I meant, but something similar just from a conceptual standpoint. So what do we have? Two options here, both the exact same policy. Option one on your left is $1.5 million moved into a cash value life insurance policy over 6 years. Why it is over 6 years? We could do it over 5 years, but when we look at a life insurance policy, I do like to look at conservative scenarios, the guarantees, and if I'm trying to get a lump sum in, the older I grow, the more sense it makes to spread it out over time. Meaning if I just want to fund a policy with a lump sum in 1 or 2 years, if I'm younger, under the age of 40, I can get away with 2 payments. One payment almost never works. It'll almost always mech out or look very ugly from a performance standpoint. As I grow older, it makes sense to spread it out. We have a lump sum study, several lump sum studies that I would encourage you to take a look at if you'd like to really understand how that works, because an objection we sometimes come across here, not an objection, call it a preference, is, hey, I'd like to be able to move the 1.5 million into the policy as quickly as possible, 1 or 2 years. And you can move it with a prepaid account, but getting into the policy takes some more time. So let's continue on here. By year 5, I've paid in $1.25 million. And look at this. I have $1.25 million, 1.258. Year 1, to go back up, I pay in $250. Got about $214, $215 there in cash value. So the majority of what I pay into the policy is available in cash value. And in this particular situation, we have an individual moving money from a bank account, CDs, as they come due, when they expire, I should say the renewal period or come for renewal, moving them into the product. Year one, I pay in $250. I've got the majority in cash value, a death benefit of $2.2 million. Year two, I pay in $250. Just about all of it comes back. We've got the annual IRR, stands for internal rate of return, what I'm actually earning. Year one, this is, if anyone's not going to do this, this is usually it right here. I make a payment, I'm older, I have a negative 14% hit on my money. If I'm younger, if you've seen any of your videos on a 40 to 50-year-old male, typically it's not that bad with a traditional type policy. It's closer to 12% or so. Age is why this one's a little bit worse. That's the first year. Year 2 and 3, negative 0.15%. What that means specifically is I'm paying in $250,000 and I'm not getting $250 back. It's not growing by $250, almost there. If I'm younger, I will see it positive by year 2 with this type of product, a whole life product where they overcharge in the first year only. Beginning year 4, okay, I'm positive, year in and year out. So the annual IRR isolates what I am earning on a particular year. So for example, if you're saying, hey, I had my funds invested in the market and I earned 20% last year or 8% last year, that's what I earned annually that particular year. If I want to say, well, what did I earn over the past 20 or 30 years? What was my average? This is where we look at the average internal rate of return, which will factor in all of the negative years. I like to look at both personally. Depends on my preference, but it is good to see both. And here we go. As time passes, you'll see the average goes positive when I break even or have more money in cash value than what I paid in. As time passes, there's my annual IRR. Remember, if I do everything right, safe, liquid, tax-free, instead of a bank account, 4% tax-free. Even if I look at the averages, tops out a little over 3, at about 3.2%. Now I'm in my 90s at that point in time. Still, repositioning assets that were just in cash into a high cash value life insurance policy. Reposition them, have access to it all the way through. If I say, you know what, this ain't for me, I can take the money out and go somewhere else with it. If I die, income tax-free death benefit is passed on to my beneficiaries, to the kids, to the grandkids, setting up a legacy. Now, with that net worth he has, it may make sense to go a bit higher than this as well, depending on one's situation. But then, over on the right, we've got a situation of, okay, after I move the 1.5 million in, does it make sense to continue to pump money in? Can I do that? The answer is yes. I don't want to continue to pay the 250 in, Steve, but if I can pay a lower amount in, I'd like to do that. So here's a model, the exact same policy. Look at this. By age 80, we stopped on the original. First 6 years, identical. I just pulled these, I ran this real quick on one company's software and dropped it onto Excel. One of the major mutual companies. Then just paying 50 per year in thereafter. He can pay in more or less. Minimum premium is closer to 23K. Paying just 50 in. Why we came up with the 50 through age 90 is in this model, we get a clean $2 million into the policy. 2.8 in cash value he's had access to as it's built up. Then if he dies, about 3.3 million left in death benefit. So I transferred $2 million that was in cash into a life insurance policy, actually saw it grow over time. My comfort level was not going anywhere else. Have my funds in business already, have money in real estate. I'm doing well. This is my liquid money. He's got a preference to move it here and has that tax-free death benefit. And there's the IRR over time. Conservative scenario, which we always like to do, but this is often how life insurance is used, and it answers the question, am I too old? The answer is no, if it's set up properly from a design standpoint, how I'm using it, all of that good stuff. So I hope you enjoyed this one. I did. I always enjoy going through these videos and really getting into the details. But reach out if you have any questions at all. I would love to connect with you. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.